Alright, so in this video we're going to be talking about what I'm going to call money insurance. So what that basically means is hard assets or tangible assets that aren't going to fluctuate day to day, but they're going to move opposite of what inflation would during times of economic uncertainty or economic depressions. So the reason I call them money insurance is when times are great, they're usually lower in price, and when times are not so great, they usually go up in price. So a couple of things that would fall into this category would be things like gold, silver, Bitcoin, ammo if you're into guns, or things like that. And the reason I say all of those things are what I would call money insurance is because when economic times get hard, those things typically tend to go up in value considerably, whereas everything else will go down in value. So a great example of that is in 2008, there was a housing crisis here in the United States, and average homes lost 30 to 50% of their market value. At the same time, the value of silver went up considerably and capped out at about $48 per ounce. Similarly, gold did something similar, and it went up somewhere in the neighborhoods of $2,000 an ounce. Now, several years prior to that, in the early 2000s, you could get silver for a couple of bucks an ounce. You could get gold for, I think, somewhere in the neighborhood of $800 to $1,200 an ounce. So when times are good, those things make very good assets to buy. When times get bad, they make a very good asset to have, so you can get rid of them and get cash, get paper dollars back. Same thing with Bitcoin. During the whole COVID pandemic, at one point in, I think, March of 2020, price of Bitcoin was down to under $4,000, and as of today, price of Bitcoin is well above $40,000 as of the making of this video. So it's one of those things, if you can buy it when it is cheap, when you have the cash to spare, they will help protect your current cash holdings, and they will act as a secondary side sort of reserve that you can redeem in times of need. I wouldn't recommend putting all of your money into any one of those. It's just something that having a little bit of each of those is a good idea, because as great as something like paper money is, having a little bit of gold, and this is, I don't know if the camera will focus on it, this is a gold tooth. I made it in dental school. It's probably worth about 40 bucks. I paid 500 bucks for the gold to make it in school. Hooray for school prices. But I'm not going to throw it away because it's worth something, and it makes a great example to show patience, so go figure. Similarly, I do have a little bit of silver. So this is a 5-ounce America the Beautiful. This is the Theodore Roosevelt one. I really like the design. I'd show it to you, but the camera's going to wash out everything, but it looks nice to look at, and if the price of silver goes through the roof, then I might end up selling some of them. I don't have a lot of those, and I don't have a large percentage of my investments or my discretionary cash in those, but it's one of those things. It's good to have maybe somewhere in the neighborhood of 1 to 5% of your total assets, real estate, stocks, small business ownership, private equity, and hard assets, having some of that set aside in things like gold, silver, Bitcoin, ammo, etc. Now, the reason I say all of those things is, if something happens and you got to move, they're usually really small, and you can throw them in a backpack, throw them in a duffel bag, throw them in the back of your car, and no one's going to know. If you have, 10 or 20 ounces of gold, that's something that fits down in the same size as a regular cell phone. Can't do the same with, the equivalent in cash. That would be much harder to transport, and it would raise a lot more suspicions. The getting back to kind of the money insurance side of that, having some of that, your assets and hard assets, things like that, that are easy to be sold, but you can keep at home. It makes your life easier if you need to get a hold of some cash, but you don't want to go and sell off a bunch of stocks and pay taxes on that. You don't want to, clear out any equity you're holding in a business, or you're not going to go and sell part of your house if you have for something like that. So it's a way to avoid going into those emergency funds if you need a large sum of cash without having to touch those, earmarked savings.